get a look at the fixed income space now with Stephen Nash from FIIG Securities. Stephen, because we're on the topic of the United States, maybe we'll start there. Good morning to you, by the way. We did see U.S. bonds have a very interesting night. That 3% psychological barrier, I guess, was breached. Tell us about that.
Look, I think the market's been shaping up for this for quite a while. We had a series of auctions last week. All went very well. I think a lot of people have been caught positioned the wrong way in the US market, being a little bit short duration, using those auctions to cover that position. Also, the data that's been coming out of the US has been building up over a period of time with regards to a weaker story from manufacturing, so I imagine the ISM report was really just confirmation of that. I think the market was sort of unconvinced before last night, but last night they accepted the lower outlook and then took those bonds through 3%. So I suppose it's a bit of a capitulation in the US bond market, which I think is really significant for the pricing of a lot of equities and for the bond market as well.
Okay, so that's significant. I mean, why is it so significant? So where is it likely to head from here?
Look, I imagine that most of the bad news in terms of the economy has been built in. I imagine that we may get a rally possibly down to 2 3/4 in the US bond market, but that's probably the major moves have already occurred. The story of the US economy is that it is growing, but it's not growing as fast as the market was expecting. I think the oil prices had a major impact on growth, and that's another factor that's pulling down growth. So growth is proceeding, but it's just not as quick as the market would have liked, that's all.
Okay. Here at home, we had the GDP data obviously released yesterday showing a contraction of 1.2%.
Yeah.
Why did we see the sell-off on the domestic bond market?
Look, the market had been building in that weaker number for quite a while, probably get a bit over, as they say in the market, a little bit long. The bond market was going into it a bit long. I think also a lot of local managers are looking for hawkish statements, a continuation of that from the RBA, and we're looking for a good level to sell the market. And as we got the GDP numbers, that was sort of a trigger to allow them to express those views. Last night, of course, the weaker US data made the market rally again, but we've come in again with the local managers looking to sell the market in anticipation of continued hawkish statements from the RBA.
Well, let's talk about the RBA, because we do obviously have the board meeting next week. Yeah. Do you think that in the wake of yesterday's GDP data that we could see any sort of a change in the approach to interest rate rises from here on in? I mean, the chances of a June rate hike pretty much are off the table. Would you agree?
Yeah. Look, I think so. I think the approach will probably be largely unchanged. They have said that they will look through higher headline CPI. They've done that, and I think they will look through this GDP number. They'll be focusing on the inflation aspects that were in the number, which were fairly contained. Also, with regard to the private demand aspect of the accounts, and again that was quite firm. So I imagine that they won't really change their approach. I think what the market's been looking for is a lot more rate hikes than I imagine will be delivered. I imagine that there will be a continued tightening, maybe one more tightening this year, but that's about it. So I think that what the market is doing is saying, well, we might get one more tightening, but that's probably it for quite a while, and what happens then? So I think 3-year bonds at 3-5% may be the new normal.
Retail sales data is expected at 11:30 today. I mean, what are you expecting, and will that sort of have any impact on the thinking?
Well, the retail sales has been soft for quite a while. You know, this theme about consumer caution is still very much in the market, and I imagine that this release will just confirm that picture. So I think all these partial releases as they come out are going to be very important for the RBA. They want to get new data on what's happening after the floods, and I think that picture is firming up, and that picture is that the non-mining sector is quite weak right now.
All right, Stephen, we've run out of time. Thanks so much for joining us. Appreciate it, as always.
All right, thanks very much.